stream.
Get ourselves started. Well, good afternoon, everyone. It is 1 p.m., and this is the first gathering of the Joint Committee on Unemployment Insurance Oversight in a very long time. So it's good that this group is getting together to meet today to have a conversation with the secretary about the solvency of the trust fund, because it has been quite some time since the committee has met. I'm going to ask each of the members to introduce themselves so that we are familiar with one another, and then we can start to view the secretary's presentation. Apologies that the lead time was a little bit tight on this first meeting, but that's, I think, a little bit of the rust from not having met for some time. And with that, I will quickly introduce myself and then turn it over to the co-chair from the House. I'm Ben Kramer. I serve on the Senate Finance Committee. This coming session will be my 20th year here in the legislature. I'm getting a little bit long in the tooth, and I acknowledge that. And for the majority of my time in the legislature, I have been serving on committees with jurisdiction over the subject matter of unemployment insurance. In my 12 years in the House, 4 were on the Judiciary Committee, and then I tunneled out and escaped in year 5 and came up in Economic Matters, where I spent 2 terms, and the 2 terms I've had here in the Senate have been on the Finance Committee. I'm from Montgomery County, for those who are interested. And with that, I'll turn it over to my co-chair to introduce herself. Thank you all for being here.
Well, thank you, Mr. Co-Chair. Delegate Lori Charkoudian.
my teeth are still relatively short. Serve on the Economic Matters Committee, chair the Unemployment Insurance Subcommittee, and really appreciate everyone making time to get here today. I'll just say a couple words by way of getting us started, and then we'll go around the room and do introductions. I actually want to start by thanking staff. Lisa's here today, and others who have been working in the background. When we called this meeting, which I didn't realize was the first Oversight Committee of the summer, so we got all the technical folks who are making this work, so thanks to the technical team. We haven't had an Oversight Committee meeting on unemployment insurance in a number of years, and this is an unusual Oversight Committee because unlike most of the Oversight Committees, most of the Oversight Committees are just House and Senate members. There's just a couple, unemployment insurance, workers' comp, a few others that have sort of broader participation like this one does. And so I think in the process of setting this up, we learned about some folks who have sort of rotated out of their positions and one organization that's listed in statute that actually doesn't exist anymore. So our apologies for the short notice, and we're really grateful for the folks who were able to make it. And I think between now and the next time that we come together, we will make sure we have everyone's accurate email addresses and that the organizations that maybe have had some turnover, managed to get somebody onto the committee so that we have a full slate by the time we come back together. We have really grateful to the secretary and her team for pulling this presentation together. And I will just mention on logistics, our next meeting is, and I'll mention this again at the end, is September 10th at 1 p.m. And at that time, we're going to take sort of the second half of the issues of the unemployment insurance trends, especially sort of related to federal layoffs, performance numbers, compliance with with Maryland law, and there's also a settlement that oversees sort of the timeliness. And then operations issues, in-house workers, call centers, those kinds of things, which we've been transferring away from. And then there was a report based on last year's legislation on work search and ghosting. So we'll be reviewing that at the September meeting. So if there is additional follow-up that needs to come out of this meeting, we can also potentially add that to that meeting, or we can have an additional meeting if we need to. Again, we're just getting this committee back up and running, so feel free to share feedback with either of us as we get things moving. And thank you again, everyone, for making it here. And I'll head that. Well, we'll have staff introduce themselves, and then we'll get members as well.
And I'm staff for the Senate Finance Committee, and I work as staff for this committee as well.
Okay, I'm Delegate Chris Adams, District 37B, which is Talbot, Dorchester, Caroline, Wacomico County, serve on Economic Matters Committee. I'm a private sector employer with 25 employees, so I bring that perspective to this wonderful committee.
Hi, everyone. I'm Elizabeth Bobo. I'm the Legislative Director at the Maryland State and D.C. AFL-CIO. If you are unfamiliar with the AFL-CIO, we represent about 600 unions, around 400,000 members, and I am filling in for Donna Edwards today.
Want me to go? Good to see everyone. My name is Johnny Mounts. I'm a state senator, proud state senator for District 37, and honored to have my colleague Christopher Adams serve on this commission. Remember, I was in the House Economic Matters, served on unemployment subcommittee, and in retro we were talking. I don't remember us meeting as a subcommittee. There may have been one or two issues back around 2015, 2016, but I'm encouraged we're having this meeting. There's a lot to discuss. Quick question, in Madam Co-Chair's remarks, you said reverse and ghosting. What were you referring to? I wasn't familiar with that. Reverse.
Work search is what I said. Work search and ghosting.
Okay, work search.
So Delegate Adams had a bill last year that, and the Department of Labor provided a report on the concerns about ghosting, and we'll be reviewing that at the next meeting.
Okay, and it's great it's an honor to be here, and good to see everybody.
Good afternoon, everyone. My name is Mike O'Halloran. I represent the National Federation of Independent Business, better known as NFIB. And for those tuning in at home and those in the audience, NFIB is the largest small business association in Maryland. We represent the quote-unquote small mom-and-pop shops, independently owned and operated. And Delegate Chris Adams happens to be a very proud NFIB member and a former LLC chair.
Hi, everybody. Kaylee Locklear. I'm the president of the Maryland Retailers Alliance, the Maryland Change Drugstore Association, and the Food Industry Council. So we represent a very big swath of employers in the state. I've served on this committee now for 9 years. The last time we met was in 2019. So we do really appreciate you all calling this meeting. So thank you.
Good afternoon, everybody. I'm Grayson Wiggins. I'm the Vice President of Government Affairs for the Maryland Chamber of Commerce. We're a statewide chamber, have about 7,000 business members.
Sure. Well, Madam Secretary, thank you so much for pulling this report together. Andrew, thanks for all your ongoing coordination and support. We'll turn it over to you if you want to go through it, if folks can hold questions until the end, and then I think we'll have sufficient time for robust questions and answers.
All right, thank you. Thank you for having me. I'm Portia Wu, Secretary of Labor. I also am part of this committee, but I'm here on behalf of the department. I'm joined by our legislative director, Andrew Fulginiti. I think I'm going to be joined shortly by one of our labor economists, Owa Faisal, who performed the modeling on this. And I also have Assistant Secretary Rachel Torres and our UI team, some of our legal team here as well. So we are here to answer questions and provide information to you. So I just want to say a few words. Like, today's briefing is really to cover basic data about the UI program and some modeling on trust fund solvency, understanding that those models require a lot of assumptions. This was a model that originally was designed and worked on by the Upjohn Institute in partnership with the U.S. Department of Labor. Our department's economists scrutinized it, applied it to Maryland, asked for a number of changes, and so we think more accurate, a picture as accurate as we have right now of solvency, but we just want to caveat it by saying, of course, it's a model. It makes a lot of assumptions. It relies on a lot of projections, but it is the closest thing we have. And then we're going to talk also about benefit adequacy. Before we dive in, I do want to say, there is a need to address UI financing over time. Quite simply, if the underlying, disjuncture between taxes and benefits continues over time, eventually that will correct itself and could happen in a very sudden way. So we're going to walk you through some scenarios to show what that picture looks like right now and a couple of different possible things that could happen. Next slide. So just a couple quick snapshots. I don't want to go into the details here, and we're happy to make sure that everyone has these slides. This is the overview. Right now, we are on Table A, so the lowest set of taxable wages and, taxable wage rates, tax rates, wage tax rates. Contributions are strong, and the balance of the trust fund is over $2 billion. That's on the contribution side. Going to the benefit side, because the state has a continued low unemployment rate, we are not seeing a high number of claims right now. Our maximum weekly benefit does still remain at $430, which has not changed in many years. And the total benefits, you can see the benefits paid over the years. Now, of course, that's the current snapshot. I think we all know that we can anticipate that things may change, perhaps somewhat drastically, over the next year, depending in large part on what happens with the federal government. Our taxable wage base is at $8,500. That is 44th in the nation. That has not been updated since 1992. And on benefits, it's important to note that these benefits have not been raised since 2010, and we can go on, I think, to the next slide to show, this is part of why the trust fund is pretty robust. Claims levels are at historic lows right now because of the incredibly low unemployment rate. But again, as I was saying, we don't anticipate that will continue. You can see, as happens over the years, you have these economic cycles and you see spikes in unemployment. And of course, that most recent spike was with the pandemic. So we're going to talk a little bit more about solvency. And I just wanted to, I think everyone's familiar with this concept, but I just wanted to touch on it briefly to make sure we're all using the same yardstick and sort of understand what that is. We're really talking about, this is one of the main measures of solvency. It's the one the federal government uses as well, called the average high cost multiple. And that's the multiplier. And it says basically how many years of, in a typical recession, how many years of benefits could your trust fund support, given what it's got right now in the till. And the measure of solvency is, do you have at least a year's worth of benefits for what has been a typical recession in your state? And the reason that benchmark is important is if we have the average high cost multiple above 1, that means we can borrow, because sometimes there are spikes, you can borrow interest-free from the federal government. You do have to pay it back relatively quickly, but the understanding is you might have a very significant economic disruption in your state. The federal government will support your trust fund as long as you have been maintaining that basic level of solvency. I will point out that some states were not able to do this. New York is a good example of where they had a very recent expensive set of additional assessments to cover some of their costs. So, it does happen that states fall below 1, and then they have to figure out a way to fill in the gaps. Next slide. So these are, I think I've covered many of these, but I want to talk about a long-term trend that's pretty important here, which is that over time, the unemployment rate is what really matters in terms of the fund's solvency. Because we know we're at a moment where that could change perhaps drastically, we thought it was important to think through, okay, what does that look like if our unemployment rate changes? We've been fortunate that it's been so low, but I don't think we can realistically count on it staying below 4% the way it has been. And even if it were to increase to the historical averages, that can create pressure on a fund. Something I also want to note is that because the taxable wage base, so that's the $8,500 over which employers pay taxes, is fixed, the only way you're getting more money in typically is for the economy to grow. So having more employees, more people paying premiums basically into the insurance fund. Inflation also means that over time, and we have a slide on this, you'll see more and more people getting towards the maximum weekly benefit of $430, right? Because that's based on the wages you were earning before. As wages go up, people's benefits also naturally go up. So what's happening is everyone's moving towards the ceiling of benefits, but that same thing isn't necessarily happening to revenue. So that's where you start seeing a gap and eventually solvency problems. So something I've also touched on briefly in front of the legislative committees is there's a kind of an inherent regressivity built into the UI tax system and benefits system, which is that especially for smaller businesses, businesses with more part-time or lower wage workers, because our taxable wage base is so low and employers are only paying the tax on the first $8,500 of wages in a year, you could have a situation like this. So you have one company, mom and pop pizza shop, they've got some part-time workers, they've got a part-time worker that makes $10,000 a year, say roughly $2,500 a quarter. If that worker gets laid off, they get $110 per week for unemployment insurance benefits. For the big corporation there, the average worker is making $100,000 a year. They're paying the exact same tax on their employer as the mom and pop pizza shop, but when their worker gets laid off, they get $430 a week, the maximum. So there can be, like I said, more and more workers are moving towards the higher benefits just because we haven't changed the thresholds in so long, but there is still this problem that means that businesses with more low-wage part-time workers are actually carrying a larger share. They're paying as much in taxes, but their workers aren't getting out as much in benefits. And of course, for them, it's a much higher proportion of their payroll than a company that has a much higher taxable wage base. So these are a couple of the modeling. So we kind of looked at two basic scenarios in modeling. We wanted to say, look, what's going to happen to the trust fund? And we made two assumptions. One, let's look at the historic average unemployment rate. So it's close to 5%. If you go back and look over the last 30-some years, close to 5% historic average. Two, a more bleak situation, what happened in the Great Recession, but not impossible, right? Something that our state has experienced before, and we know right now we could be facing some serious economic disruptions. So we thought, let's also model a Great Recession type scenario where we suddenly have relatively significant increases in unemployment, because that felt like that's the responsible thing to do, is look at both of those scenarios. And in doing that, we said, well, let's look at what about if we do nothing? What happens under each unemployment scenario? And then we took some different projections using maximum weekly benefit amounts and taxable wage-based changes. Again, the department does not have a position on these. We just modeled these different versions because our understanding is that's what, first of all, the legislative committees have had proposals like this in front of them in the past. We thought these would be useful examples for this committee to have a look at. I know we said we'd hold questions to the end, but I know we're going through a lot. I just wanted to make sure everyone's following, and the chairs, yeah, okay. Is there anything?
Does anyone have any
so
questions?
far? I mean, we'll show like each of the different models and things, but before we get into that, I'm happy that, yeah.
Quick question, and forgive me if it was included in fiscal note for Delegate Charkoudian and Senator Kramer's bill earlier this session. But do you have, similar to this, historical data on the ACHM or AHCM? In other words, like where have we been? I know that 1.0 is kind of the benchmark that's in good standing, and it says that we're currently above 1.0. And if it is in here, I apologize, but
it is not. We had a chart in there, but we thought it might be confusing. We're happy to share it. It went up and down pretty drastically, and Maryland has been below 1 before.
Sure.
What has happened in most of the recent instances is, for example, in the Great Recession, I believe federal labor made an exception because everyone was suddenly in this situation that's okay, even if your average high-cost multiple was below 1, we'll still let you for a short period of time borrow interest-free, like they made an exception. In the pandemic, what happened is Maryland used $800 million of ARPA funds to plug our hole. So, but I think the thing so we know when there is a national significant downturn, federal labor tries to use some of the tools in its toolbox to give states relief. I think what's a concern for Maryland potentially is because we're so disproportionately impacted by federal cuts, special federal employee cuts. So 1 in 7 Maryland employees is a federal employee or a federal contractor. So that has a huge potential ripple effect for private sector businesses as well. I think we're concerned that we don't know that we could count on that level of federal assistance or those changes because if it's not a national phenomenon, if it's a more state-by-state based phenomenon, we might not, we won't necessarily have an ARPA, set of money or like big changes at federal policy lever side.
Could I ask a follow-up on that? Because you brought up an important point about Maryland and its relationship with the federal government, and 1 in 7 are either federal employees or federal contractors. But federal employees, explain to me how, if they are laid off, how does that impact the state's unemployment insurance fund, or does it? Because I believe it's you guys are the experts, but it's something similar to our partners in the nonprofit world in that they are reimbursed, correct?
Exactly. So the modeling we're about to go through talks about general unemployment. It doesn't break out federal employees separately. The federal employees are reimbursed. So, for example, they don't pay insurance into the fund. The federal agencies don't pay insurance. When federal employees are laid off and eligible for unemployment, the federal agencies pay us back. It's paid out of our trust fund initially, but the federal government reimburses us. That's correct. So, for example, if we were to say it's 7% unemployment and all of those is due to federal workers, it wouldn't have the same kind of impact on the trend. However, we know that recessionary situation isn't just because of federal workforce, right? It's because that has ripple effects and private sector employers are impacted. And also what can happen is there are other kinds of contributory employers. For example, they may go out of business. So in theory, or people may not be able to pay premiums anymore. So the trust fund has to be that insurance pool, sort of making sure that it's covering things for everyone, even those who are no longer able to contribute or reimburse for whatever reason.
Understood. Thank you. Thank you.
So this is what things look like under the model today. You can see with the average forecast, again, that's the blue line. So that's the assuming roughly 5% unemployment going forward. And then the recessionary forecast. So what would happen if we were not going to, if we were going to see something closer to what we saw in the Great Recession? So a spike in unemployment and then gradually coming back to more normal levels. So under either of these, you can see that we are looking at the average high cost multiple dipping below 1 in the relatively near future. Next slide.
Can I just ask for
Yes.
clarification on that?
Yes.
Because I want to sort of follow up on Mike's question. So the blue line is not assuming major federal layoffs. That just assumes that Maryland's unemployment kind of comes in line with national rates of unemployment as opposed to the historically low one, or does that assume significant federal layoffs?
I mean, I think, look, we're currently at, what, 3.2, 3.4? So it would be a significant increase to suddenly be at 4.9. And I think we could assume some portion of that might be federal layoffs. But Mike's absolutely right that the trust fund itself, we didn't model, okay, if you have 5% unemployment, if 0.3% of that is due to federal workers, how does that change the trust fund? We did not model that or pull that out.
Thanks.
This is based on general unemployment projections. So the next slide is a little bit tricky to follow, and I'll do my best to explain it. Maybe I'll look to Andrew to pitch in and help me. Oh, Erwin's here? Yeah, you should come up to the table. I'm sorry, Erwin. So this is Erwin Faisal. She did all the modeling for this, so I'm glad she's here to help me answer tough questions. So what's happening here is basically not changing anything, but remember what I talked about, the flow of revenues and benefits. So the benefits paid over time, you expect them to typically go up. And then because wages keep going up because of inflation, and so more and more people are getting to the higher levels of benefits. But what we see also on the trust fund flow is that's the blue line, and that's the revenue. So what happens is over time, things are going down like you saw with no change. Over time, the tax tables correct, because as we know, as the trust fund level drops, then suddenly we shift from tax table A to B to C. And so, for example, on the lowest level of tax table A, which is where the vast majority of employers are paying, right now I think it's 0.03%, and it shifts up to 0.06 on table B. So that's why you see sort of sudden disjunctures like that and jumps. And the reason we showed this chart is that you have employers potentially going from like table A to table D in recessionary forecast, or then even in an average flow forecast, it's A to B to D. So there's a kind of an inherent gap that's already built in to what's happening now with the taxable wage base and benefits. And so what will happen is as soon as there's some pressure from unemployment, employers are going to see significant jumps up on the tax tables. The reason we put this out there, and we're happy to explain it more, is the cost of doing nothing is not nothing. Does that make sense? Right? Like if we just keep on the current path, at some point taxes are going to go up probably in a pretty precipitous way because of the jumps in the tables. So that's the status quo.
Just to make sure that understand the chart. So the chart that's in front of us right now,
Yes.
the total benefits paid, for instance, the orange line on the left-hand graph, those are the average forecast, or the average projection, but those include an increase in the weekly benefit amount, correct?
This is keeping it at 430. This
Okay.
is current status. The reason it goes up is because, you see the jump up is because it assumes a recession. So that's total unemployment benefits, and you're thinking, okay, we're going into recession, so a whole bunch more people are filing for unemployment. That's on the right side. On the left side, the reason you see it gradually going up is the inflationary effect I talked about before, which is as over time people's wages go up, so more and more people are getting $430 a week instead of $250 a week or $320 a week. So and of course you have population growth too. So you start seeing, benefits, total benefits paid out increase.
All right, so I guess I'm still confused because on slide 10, under historic average projection, it says maximum weekly benefit flat increase to either 630 or 750.
We haven't gotten to those slides yet. We'll show you those. Yeah, this is
Gotcha.
This is current program. That's why you see it says current program at the top.
Okay.
On the prior
Well,
slides, current
I
program.
figured that, but I was still just, because it said average forecast, and then I went back to, okay.
Yeah, so
Got
this
it.
is the current program under an average forecast, which is roughly 5% unemployment, or a recessionary unemployment forecast. The reason we're not seeing it today is because recently we've had super low unemployment. So that's why we've been able to drop back down to tax tables. You're not seeing this, but I don't think we can count on that.
Can you say that one more time? So the average that we're looking at here is 5% unemployment, is that correct?
Yeah, the left,
Okay,
so the
thank
average
you.
forecast is actually 4.9, and that's based on the historical average from, I think,
From 1990 to
1990 to now. So it's, it's a pretty typical 5%. I think we think that's pretty typical. And it's been Maryland's historic average experience. And the right is based on the Great Recessionary unemployment, where we went up to, what did we go up to then?
I think it went up to like 7.5.
7.5. So, a more significant rapid increase.
Sorry to interrupt. Can we just get you to introduce yourself for the record? Because I don't think we got you on record. Thank you.
Hello, my name is Erla Fassel. I'm the Labor Market Information Specialist for the Maryland Department of Labor.
In these graphs, see, there's a forecast for a recession, and then there's an average forecast, but there isn't a forecast for a strong economy.
So we previously did have one, which is maintaining current unemployment rates of 3-ish%. We took it out for this presentation just because there were so many lines. It was a little confusing. We're happy to provide that. And I think we actually did provide it when we did a finance committee and ECM briefings earlier during the session. We're happy to provide that as well.
Thank you.
I will say, in part, I do feel like it's our job to prepare for the worst. Obviously, we can assume something in between. But I think the reason we did average is, over time, things always go to the average, right? Like that's their nature. So I think we should at least be able to cover the average scenario over the longer term. So the next slide, don't want people to be alarmed, but there's a lot of lines. Basically what it is, it's a series of different combinations of, you see how it says MWB at the bottom and TWB. So that's increasing the maximum weekly benefit to whatever the number is after it, and then the taxable wage base. So we did a bunch of different permutations. And as you'll see, obviously things that have the greatest increase to the taxable wage base, in this case, that's the green and the blue lines, those are the ones that maintain the solvency the most. Interestingly, it's really the taxable wage base side that I would say, or correct me if I'm wrong, but I think that's really what has the greatest impact. The benefits make a big difference as well, but it's interesting that you're seeing most of those lines between 530, 630, whatever, they're closer together, and those are some of the darker lines below the average high cost multiple of 1. So, they work in tandem, right? Like if you increase the taxable wage base, you're obviously bringing in more revenue. If you're increasing the benefits, you're spending out more. So you have to figure out what is the combination or balance that makes the most sense in order to maintain solvency. I think what's more concerning, and Senator Mouse, this gets to your point, you could make a bunch of changes in an average forecast that might keep us, closer above 1, right? I think it's easier. Where I think it gets more difficult is solvency, in a more recessionary forecast, where a lot of these, you see significant drops, and you're going to fall below the average high-cost multiplier of 1 in most cases. I think this just tells us, look, the main controller in the model really is unemployment. And when you're hitting really high unemployment, that is where you do start to say, well, it's difficult under any of those scenarios. But that's the purpose of having the trust fund and being able to borrow from federal labor, is you want to generally stay above 1, so when you need to take that emergency action, it's there for you, and you can resort to that federal assistance if needed. So, in all of these scenarios, even if you're changing things like increasing the taxable wage base or increasing benefits, you're going to see a situation where we're going to fall below 1 in a significant recession. A couple other points we just wanted to share. I referred to the maximum weekly benefit amount. This is where we fall sort of regionally. We're 36th in the nation. And the next slide shows the point I had made earlier. It just shows it in a graphical way of, the last time we increased the maximum weekly benefit was about 15 years ago. This is the longest time we've gone without, addressing the max. And over time, you see the green line there is the average weekly benefit. And as I said, it's creeping up over time, right? More and more people are getting closer to the max. And that also accounted for the line you saw earlier of the benefits trending upwards slowly over time, total benefits paid out trending upwards over time. Yeah. Oh, sure. Sorry. Yeah.
Do you have any input or idea of, because you just showed the slide of the table of some of our neighboring states and what they kind of look like with UI benefits and their calculations. That one. Do we know who out of those states that you have listed have changed their calculations as well, or having the same conversations that we're having about this? Like, when was the last time? Because we haven't changed ours in 15 years, you just said. Is that kind of like a similar trend in other states?
I do not know off the top of my head, but we can certainly check when the last time was that some of the other states have taken action.
Thank you, because I think it's just important to know some
Yes.
of our neighboring states and
Absolutely.
similar states.
Right. And of course, economies, especially our economy, is heavily regional, so understanding what's happening with the other states is important as well. Delegate.
Secretary, so you said 2010 was the last time it was raised.
Yes.
I mean, that was in the aftermath of the mortgage-backed security crisis, so I guess we're calling that the Great Recession. But the point is, was that increase buttressed with some of this federal money that sometimes comes when we go through these recessionary periods? In other words, was the state of Maryland able to increase the benefit amount because the federal government was coming in and helping us through that exercise?
Delegate, I was not here. We can double check on that. I will say typically what happens, and I believe was a lot of what happened with the Great Recession, I mean, there was certainly money that comes in the form of extended federal benefits, right? So often that assistance is additional weeks of benefits that are just fully paid for by the federal government. I do recall in the UI modernization, there were grants to states that made additional changes to their benefits, for example, alternate base periods or covering more workers who were under part-time employment. I'm sure Maryland got some support during that time. I don't know, though, that we could really say over time that that would be enough to really fund additional benefits. Andrew, I don't know if you have any sense?
No, and I think to your question, I think the answer is, my understanding is the state did access an interest-free loan from the federal government at the time to address that. I think that goes to the Secretary's point about why the average high-cost multiplier is important, because the state took advantage of that at that time.
Yeah, but you have to pay that loan back pretty quickly.
Okay.
So that would not have meant that we, over time, were able to increase the benefits because of that loan. There were a bunch of funds to states, but I think they were modernization grants and maybe helped on the margins. But we can find out what the grant to Maryland was at that time.
Yeah, and the only reason I'm asking is just to try to understand when the state of Maryland last did this, what was the financial impetus and or ability for us to do it. So whether it was borrowing money short-term, that may have been the last time Maryland actually went to borrow money, but if it wasn't, was it a grant or some type of federal? So I would like to just know the way we did that.
Thank Thank you for that question, Delegate Adams. I actually want to piggyback on that as well, if I can, because it looks like, and I don't know if you're able to look into the history, because it looks like there's actually sort of a pattern of every 2 or 3 years increasing the benefits. So the longest period before that is sort of this 96 to 2001 period where it stayed at whatever that was, 250. And then really every year, 2, 3 years, it increases, and then it's flat for 15 years, which does seem unusual. Like, it seems like unlike the trend. So I don't know if you're able to sort of look into legislative history or labor history or what it is that might have driven that. I think certainly our access to any federal money, and although I think the federal money really was in 2021, right? We got the extended, the COVID extended beyond the 26 weeks, the supplemental, and then we chose to put close to $1 billion into the trust fund. So there may be, to Delegate Adams' question, something that happened in 2015, but I'm also really interested in sort of, to the extent you have the ability to find out about why we were sort of every few years increasing it and then sort of stepped away from that in 2015.
You can go back and try to research it.
Thank you.
Absolutely.
So, sorry, just really quickly, and pending that the chart that I'm looking at is correct, because, and I'm glad you included this, because I also, like to know nationally, where does Maryland fall? Although obviously there are different costs of living in states, right? But the number that I came up with is actually 30th in the country. And I'm assuming you're looking at the max average weekly benefit. Is that what we're looking at?
We're looking at the
with
max.
this?
We're looking at the maximum benefit.
Yeah. So when I look at the national chart, I see Maryland as 30th. So I was just curious about how we got there. And I might have something different, but.
Are you using the average weekly benefit or the max?
Sorry. I'm using the max is
Okay.
what I'm looking at right now for the weekly payout.
We can.
In other states,
ask
yeah.
the team to double check. Is this the most recent version? Yes, is that a yes? Yes. Okay, this is from 2024 or 2025? We can double check against
So
your numbers.
25 is what I would look at.
Yeah.
That's what I'm looking at right now.
Yes, but my team's saying this is also 2025. We'll double check. I'm not sure, but I don't think we could have risen without increasing our benefits, because I don't think states would have gone back the other way. But we can double check.
Thank you.
Yes.
Interesting to take a look at what inflation was during the same period of time since benefits were increased, what the buying value of a dollar was over this period of time. And I know we did have a stretch of historically low inflation, and we've seen that change for a period of a few years since the pandemic, when inflation responded to the global economy and increased dramatically. So I think that would also be of value if maybe we can try to get a little bit of a handle on that, to try to see just what those benefits reflect going back to 2010 and the buying power of that exact same money today in 2025.
Absolutely, Senator. We provided this chart, but the way you formulated the question now is slightly different. So we can certainly look at the costs versus the benefits then. This is, just a straight dollar calculation of what happened, has happened over time, using median gross rents as an example. We do know that, of course, because we don't have the metropolitan statistical analysis back before 2015, we wanted to do some more regional, so we went back to 2015, and here's an example that basically, you've had a 24% decrease in purchasing power in that last decade, even though we did actually have a couple of years where inflation was quite low in that time. You still already had a huge erosion, and I think comparing the Maryland rents to the national also shows that whether we're 30th or 36th, the fact is cost-wise, we are, top 10, I think, in the country. So we have to, I think about how that purchasing power, what that can purchase in a typical Maryland market. So we're happy to go back and do a little bit more of that analysis so we can dive deeper
That might
on
just
it.
be useful so we have a better understanding of what the implications are. Mike, please.
And I think that's a very cogent point, because I like to use big words here and there. But I think also would be very helpful, since Maryland, only employers are paying in, correct? So I think not only perhaps a residential, I'm assuming this is, residential rent, but
Yes.
also commercial rent. In other words, basically the purchasing power of a small business, let's say, because there are numerous factors, well outside, I think the jurisdiction of this committee, but, certainly as legislators, you all are very well aware that, some of the costs that businesses have taken on, let's say since, I guess 2015, paid sick and safe leave, paid family and medical leave insurance, which is yet to come on board. So I think, when you're talking about the purchasing power, I think it's also important to include, some of those dynamics that employers are facing, since they're the ones that are funding the trust fund.
I think this is our last slide in the presentation, so we're happy to take other questions, and obviously, Erwa's here to help us answer if you have more technical questions about some of the modeling.
I apologize. You're wrapped up, Secretary?
Yes, that's our last slide. That's our last slide.
Okay, terrific. Folks, anyone have any questions, comments for the Secretary, or just for the general good of the committee? I see Delegate Adams is pondering.
Employers pay for like 47 states. It's very normal for employers to cover the UI trust fund.
Go ahead, go for broke, Delegate Adams.
So thank you for the presentation. I believe that the information you're sharing is interesting because it shows me that the department is deeply concerned about where the economy is headed, as I think all of us are. Clearly going into the next legislative session, we'll know more. I think we will know more about what's happening with the economy. And as an employer, I've been told that a mild recession is coming, notwithstanding Maryland's position and its proximity to Washington, just the general nature of what's happening, how the Federal Reserve is reacting and responding to the economy, how inflation is going to affect the national economy. So you're smart and right to share the information, and the way you're going about it tells me that you've got concerns, and I receive that just as I would an employer. I'm a business owner that is trying to make strategic decisions on hiring, laying off, am I growing the business or am I staying pat for a moment and just seeing what's happening? And so my only comment is, first off, thanks for having a meeting like this about UI, having a interest in wherever this is leading, both the employees who will likely have some stress over time if inflation continues at the rate that it's going. And I'm sure on balance, you represent and regulate the interest of the private sector in this. And so I think there's the other side of that coin. And I'm anxious to see, moving forward, if there's policy action that comes from the committee, what that looks like. And, can we as a state improve the outcome for some of the people that go on unemployment, but at the same time pay some serious concern and respect for the private sector, which I know we will. I don't doubt that one iota. But I do believe it's very important to understand we're not in normal times. I think it's safe to say that we are, as a state of Maryland, coming through this as first blush. This feels like a unique setting over time for the state of Maryland. I don't know that, I've been here since I was born in 1972, so there's been a lot that's happened, but at least in my 11-year career, I don't think we've asked these kind of questions in the way that you're asking them. We've always had the Department of Labor come in and give us a 30-minute overview. Here's the UI Trust Fund. Things look great, or maybe not. And, back when you and I were on the committee together, Senator Kramer, and you sat 2 down from me, we would have those briefings. I never felt uncomfortable about the Department of Labor in their presentation about the UI Trust Fund. I'm trying to read from you whether you're uncomfortable now, but maybe that's conversation for the next meeting. But let me just close.
Delegate Adams, let's get an answer to your question. Madam Secretary, can you opine as to?
Delegate, it sounded like you wanted to add a little bit more.
I'm just going to close.
Yeah.
Please answer the question, but I'm just going to close by saying that I think it's very thoughtful and important that we certainly discuss this, and I respect the tenor you're bringing the presentation to us.
Thank you. Thank you,
So,
Delegate.
go ahead and.
Well, first of all, we know there have been active conversations in the General Assembly, and I think our goal in providing this modeling early and wanting to engage early is if there are different questions you have, any of the stakeholders in this committee have, let us know that sooner rather than later so we can model them, so we can have a debate and discussion. I know one of the things that came up during last session is people felt that, they wanted to be able to have an exchange and input on that, and it does take us a little time. My first year here, we weren't able to get the modeling done in time, and it turned out there were a number of defects in the underlying model, so I'm glad we took the time to pressure test them. You've seen what we're seeing. I think the thing that concerns me most about one of those slides is the ones where the kind of all the weird, like, sudden upturns is those upturns happen when the trust fund drops, and the reason the trust fund is dropping is because unemployment is high. And at that moment, to say to employers, okay, now we're going to double or triple your tax rate, like that is a really, really tough hit. And so the point of unemployment insurance is to be countercyclical, and it helps for the individuals who get the benefits. So first of all, you have to ensure the benefits are robust enough to really keep people in their homes, not having them lose their house or their car, being able to have that so they can find another job and get back to work, tide them over that. But you also have to think about the impact on employers and thinking about how can we look ahead, because as over time we don't adjust these rates, it does mean, and employers experienced this significantly during pandemic, but frankly, if it had not been for the ARPA funds, they would have been staying up there at table F or whatever it was, at much higher levels.
Thank you,
so
President
we don't
Biden.
want that to happen. I'm sorry.
No.
Okay.
Sorry. Couldn't help myself.
So I think that's the concern. That's the concern, is how can we look ahead and try to smooth that out and take the appropriate actions to align the benefits levels so they can be adequate, but also ensure the taxable wage-based support is there. I also do think having such a low taxable wage base, as I showed in that illustration, we also have concerns that for smaller businesses with a lot of part-time workers, that they are maybe paying more of that cost, a disproportionate amount of that cost.
Actually, on that, and perhaps this is more for your colleagues at DLS than maybe within the department specifically, but I'll just throw it out there. I think, would also help as we're talking about modeling is, clearly as you laid out in your presentation, there are some options, in increasing the weekly benefit to X, increasing the taxable wage base to Y. I think, and I say DLS simply because I'm thinking back during session, they produced a document on the BRFA saying, the tax increases included on the personal income tax rates would impact, family A this way, family B this way. I think if possible, whether, again, department or DLS, but I think something similar for, employer A, employer B, and model that, I think that would be very, very helpful as well. Because again, I don't think I'm going too far afoot, but I'm assuming there'll be some sort of legislation in 2026 to perhaps approach some of these issues. So I think, the more information I think all of us in the employer and employee community have in terms of what the real life impact is, I think would be very helpful.
It's almost like you're a fortune teller.
I just, call me whatever it is, Zohan on the boardwalk. That's me. That's me.
Kaylee? So I know that on the agenda, there's an item for additional questions and discussion, but I didn't know if the department was going to come back then. I wanted to hone in on another area that might be another focus for another meeting, which has to do with the fraudulent unemployment data that's posted. I just, in general, had a bunch of questions around that, and whether it's cumulative, I just have a bunch of questions in there. So if you want me to hold that, I'm glad to, but.
Next meeting?
So let's do this, yeah. Why don't you maybe write out your questions, and we'll see if we can add that to the next meeting.
Our September meeting.
Okay.
And if I made Delegate Adams' point, he's spot on that I think the whole purpose of our getting together and starting to meet now and have this conversation is so that we have a better handle on what's happening. I mean, some of the slides are a little bit scary, and they're getting my attention. I think we all appreciate and value our businesses in the state and ensuring their viability, but we're also weighing that against what we're looking at as being forecasted, our solvency of the fund. And I think engaging in this scenario with this body, we're beginning the conversation. So when we do get into session, we have a better handle of where we might want to go and how we do want to address this, keeping in mind all the checks and balances that are important to all of us. And so I think Senator Mounts first.
This is a different issue, and I was thinking about whether to bring it up or not. And I know we're looking towards the future, and we're looking at projections and things like that. But 2 years ago, the Comptroller's Office switched to this online portal. And I know, we're talking about the payment of the benefits. There have been, entire counties have had to kind of go around the whole flagging system and the Comptroller's Office. And I was interested, maybe in the next meeting, if we could talk about, the flow of payments coming into the trust fund, how they're handled and how those issues are being addressed, and whether they even appear to be an issue for the Department of Labor. I'm not sure exactly how the money comes in, if there's a timeliness or things like that. But I know that's a portal for businesses that they use to file taxes, sales tax, withholding, things like that. And to the best of my knowledge, is what's occurred is a number of businesses have been they've been able to file, but they haven't been able to pay them. The state has not collected the money. And so if we're talking about moving forward, we certainly have to have a system that works, especially if you've got taxpayers trying to pay and the government isn't collecting it, and then they're being identified as being non-payers.
Well, Senator, I can't speak to the details of the comptroller system. At this point, the UI tax system is still operating independently. We looked at, with family and medical leave, trying to fold it into the comptroller system. At that time, the comptroller, they wanted to get their main system all set before turning to employer side taxes for family and medical leave, and it looked like that was going to be a number of years out, and we thought that was not on the same timeline. I would like eventually to have employers to have a more seamless system, right? Instead of saying, why do I have to have these different logins, these different systems? Wait, I thought I paid it here. What do you mean I have to pay that? Like, I understand it's very frustrating. That said, because things are still being worked out with the comptroller system, at this point, we're still using our separate wage, tax collection system, because in part, the third-party providers, the payroll companies, they know how to do it, they're comfortable with it, but we're happy to get some stats on the on both the business side responsiveness as well as on the claim side responsiveness. I do want to speak to a point that NFIB brought up earlier, is that I think that if you look at the lines on the tax tables, and we can break it out, sort of like my experience as an individual business owner, not just in the aggregate, the vast majority of businesses fall on the bottom line in whatever table you're in, like 90,000 businesses. So typically, if you're saying, what's happening to my business, most of them fall there. Then, of course, there's experience base, and they move up and down, but most of the businesses in Maryland are actually paying at the bottom line of the lowest rate on the table. Yeah, the bottom. Yeah, then there's another like new business rate, right? Of course, if you're new, relatively new, then you pay a slightly different rate. I think right now it's 2.6. And then there's, we do have a rate. If we keep asking you and you haven't responded, we automatically assign you a rate, and then you can come back to us and explain why that's the wrong rate, and we'll help you work it out. But, so, but we're happy to tell the story from the sort of like, what does an individual business experience under some of those lines? What would it look like to them?
Yeah, to be clear, I didn't mean so much as in, on the tables and the experience rating example, more of just like, hey, I'm a small business owner that's $400,000 gross profit, and I have 10 employees. Those sorts of examples.
Sure.
Again, I don't know.
Yeah.
That
Right.
may be more apropos for another big word for DLS. I just don't know.
Yeah. Right now, people are paying about $26 a head. Is it $25.75, something like that, per year?
Madam
That's what
Secretary, I
most
think
people
that you created a chart for when we were analyzing some of the proposals within the bill that we had last year that may answer this question, because I think that what we had, I don't have it in front of me, but I think you have a chart that says if we increase it to $10,000 taxable wage base, if we increase it to $12,000, here's what businesses with this profile would pay, here's what businesses with this profile would pay. Am I remembering right
Yes,
that
we
we
could,
have that?
and we're happy to do that again. It was just a lot of different charts with numbers, but I also find it easier to say, okay, I'm paying $26 a head now, that would become $40 a head for like each year. It's just easier to think about it that way, so we do have that and happy to provide it.
I think it would be helpful to, just since we're sort of putting together what additional information we need, I think that's helpful. And I think there's another point that you've made a few times, which I think is important, which is about how taxes will go up, and they'll go up abruptly, right? So we talk about like, how do we fix the roof when the sun's shining? I'm not sure the sun's still shining, but assuming it is, on our rates anyways, like what, sort of like if we do this sort of this year, we're going from 26 ahead to 40 or 35 or whatever those numbers are for 75% of the businesses, and then 25 with a higher experience rating, go up to $50 a head or whatever that might be. I think that's helpful. I think what we may want to add to it, because I think the thing that you had in today's analysis that struck me in a way that I hadn't thought about it as much is, or what happens when we suddenly jump to table B or C in a recession potentially, when folks are already struggling, what does that do to what businesses are paying and in what time frames? I think sort of understanding, to your point about the cost of doing nothing isn't nothing. And so I think that would be useful as well. Liz, sorry.
Oh, there it is. So thank you. I'm just going to echo what everyone else has said. Thank you. UI is a very complex issue, and it's not easy to understand, and I think you just made it a little bit easier for me to understand, which is great. I'm wondering if at the next meeting we would be able to dive a little bit deeper into unemployment, since everyone has mentioned that being, unemployment spikes, it kind of sets off a domino effect to everything else, right? So if we're looking at projected unemployment, because right now we're sitting at, 3.2% in Maryland, in your expert opinion, right, where do you see that spike happening? Because obviously it's coming. Delegate Adams, just mentioned, a mob recession that we might be going into. So kind of looking at the different forecasts that we've been looking at, if we can prepare better, obviously looking at a projection of when we can expect, obviously that's like an ideal situation, but when we can expect this spike in unemployment to come, I think would do the conversation a little bit better in terms of preparing for that.
I think we felt like if we knew that, I would be in a different job, making a lot more money and having a lot more power. But I think that, it's just so difficult, and we are in unprecedented times, and, you can guess at a lot of things. I think that's why we felt, certainly using a historical average, and I personally even feel like 4.9% is kind of conservative. Like when I was in college taking economics, right, average unemployment was 6. That's what we learned in textbooks. It was 6. So saying 4.9 or 5 doesn't seem unrealistic. I think, look, we're talking a lot about federal government. I don't know what AI is going to do to jobs. I don't think any of us knows, right? The confluence of those two things, especially in Maryland, a state with a very high dependence on knowledge jobs and knowledge workers, AI has the chance to be a very significant disruptor, especially in entry-level jobs. So I think it's just very difficult for us to predict that. What we can do is say, look, we have these examples. I think the Great Recession is a better example than pandemic because that was so sudden and unexpected. The Great Recession, was significant, but it didn't happen literally over a 2-week span. So I think that's why we use those two models. We're happy to try to model different scenarios, but I think, or was the economist, you can tell us, but I think we can't really guess at this point, how fast are we going to move from 3.2 to 6 or 5 or 7? I just don't. I think it's really hard for us to say. I mean, we're fortunate if you look at the recent months. Maryland's private sector job growth has continued reasonably strong, but even that's a BLS model, right? We're also not seeing yet super high increases in unemployment insurance claims, but we are seeing increases. And we know part of that is because of the federal structure where even the feds, I think we have 2,100 claims that have come in from federal employees right now. Some of that's because those people are filing in DC because that's where they work, but they live in Maryland. So they're still not going to be able to make their mortgage in Maryland, even though they're filing in DC. And some of it is also because people are on a severance or some kind of voluntary retirement or other, fork in the road plans. And so they may not file today, but they may be filing in October. And that's probably thousands of people that we haven't yet seen. So there's some other shoes yet to drop, if that's helpful. So we're happy to do our best to prognosticate, but I think they are at best educated guesses.
Great. So if there aren't other questions, I just want to talk about a couple of next steps. I think that you were trying to answer, there was one other question that was asked that was about employee contributions. I think you were about to say there's 2 other states that.
So it's very normal for employers to be, it's the norm for employers to be contributing to the trust fund. That's the case for 47 out of 50 states. So it's not something that's unusual or unique to Maryland. And
Okay.
it's not even we don't even have a way
Can you
we
just
could
talk into a microphone?
we don't even really have a way that we could model changing that because that's the way that most of the country works.
Okay, thank you. So you've gotten a bunch more questions.
We did.
In your attempt to not overwhelm us, I think we turned around and said to you, please overwhelm us. So I think if you don't mind sort of adding to the slide deck, we can get it out to everybody. And then if the committee wants to add anything else from sort of follow up on this to our next agenda, we can do that as well, because I think there's a lot of these areas where after we look at some additional slides that you may send, people may have additional questions, so we can add that. I think there's also the questions about UI operations. We had talked about in-house workers call centers. I think that's been an issue that we've been talking about, but that could also be a place where questions about how employers see and put their contributions in and challenges with that, what that looks like, how that fits with comptroller or other sort of systems, as well as potentially the experience that workers have when they're filing and how sort of beacon that system is working. And then I think a question about how fraud, which as I understand it is primarily sort of international crime rings is most of the fraud that we're sort of responding to, but whatever kind of fraud, sort of, if that can get added in terms of the question that was asked, like what those protections are. If folks have other questions that come up soon, because this will take you a little while to get the September stuff together. So if people have other questions, let's get them in soon, so that we're not kind of popping them on the department, a few days before the hearing.
Madam Chair, I was just going to ask, perhaps what we could do is we could connect with the staff and just, after you have that list, let's make sure we understood what we have come away with. I suspect this volume of questions plus all the operational issues and fraud and some of the policy issues I know people want to cover might make for an incredibly long meeting in September, but we're happy to prioritize and sequence them and focus on whatever would be most useful for this committee.
We can schedule another meeting as well, yeah, if necessary. So we'll be in touch with you all and with staff. So folks should let us know if there's something else you want added that we haven't discussed. And thank you all so much. Really appreciate your time. Thanks,
for your
everyone, for
leadership.
coming.